How does a business know whether it is profitable? At the end of each accounting period, the entity prepares its financial statements. The period may be a month, 3 months, 6 months, or a full year. Whatever the length of the period, the end accounting product is the financial statements. And the most important single amount in these statements is the net income or net loss for the period. In this unit, we will look at these financial statements in order to measure net income and loss through the adjusting process. In accrual basis accounting, business events are recorded as they occur. In cash basis accounting, only those events that affect cash are recorded. You can distinguish cash and accrual accounting on a cash basis. Here you record revenue when you receive cash, regardless of when the service was performed or the sale made. Record expenses when you pay cash, regardless of when the expense was incurred. Accrual basis, forget cash flow. Record revenue when you make a sale or perform a service. Record expenses when the business uses goods or services. Revenues and expenses may not coincide with cash flows. Businesses divide time into definite periods, such as a month, a quarter, or a year, to report the entity's financial statements. The year is the basic accounting period, but companies prepare financial statements as often as they need the information. The revenue principle helps accountants determine when to record revenue and the amount of revenue to record. Revenue is recorded after it has been earned, and not before. The matching principle directs accountants to match expenses against revenues earned during a particular period of time. Adjusting entries are a result of the accrual basis of accounting. Made at the end of the period, these entries update the accounts for preparation of the financial statements. Adjusting entries are divided into 5 categories: prepaid expenses, depreciation, accrued expenses, accrued revenues, and unearned revenues. The adjusted trial balance is a list of all the ledger accounts with their adjusted balances, useful in preparing the financial statements. To prepare the adjusted trial balance, accountants enter the adjusting entries next to the unadjusted trial balance and compute each account's balance. The adjusted trial balance can be used to prepare the financial statements. Income, shown on the income statement, increases the owner's capital, which also appears on the statement of owner's equity. The ending balance of capital is the last amount recorded on the balance sheet.